Good morning, team. Let's start with our last session on foreign exchange exposure and risk management. Today, we will be covering the questions on majorly on the exchange cancellations, early delivery, or extension of contracts. So we have discussed earlier also one or two questions on this. Today, we will practice it further. And we talked about that a cancellation, a delivery of a contract can occur. Let's say if it is a delivery, a customer can have delivery either on due date or before due date, that is early delivery, or he may have after the due date, a delayed delivery. Similarly, he may also not want a delivery and he may ask for cancellation of a contract. So on the same grounds, cancellation can be done on the due date, before the due date, if it is done before due date, forward rates would be applicable, and it may also be done after the due date. And similarly, sometimes the customer may want that after cancellation, the contract may be extended. So this request can also be made either on due date or before or after the due date. In case the customer asks for extension, we have to look for the forward rates for the date. A new contract would be entered with the customer for extending the contract. So a new rate would be established basis the forward rate on that date. We have done this question. Let's do a quick revision of this one question here. On 1st October 2015, Mr. X, an exporter. So once again, I'm repeating that you have to be very careful when you are doing a cancellation or an extension or an early delivery. You have to look forward to be careful whether it's a person is an exporter or an importer. Generally, it is up to you whether you think from the contract from the perspective of a bank or from the customer. Whatever you are comfortable with it, you can do that. But remember, an exporter will always be having foreign currency. Exporter will be receiving foreign currency. Which he wants to sell to the bank. So when he sells this, indirectly, the bank is going to buy and bid rate is applicable. So in case of exporter, the bank buys the foreign currency, so bid rate is applicable. If this contract is cancelled, the bank will buy. So to cancel it, it has to be sold. Reverse position has to be taken. So bank purchases and sells, or the exporter sells or purchases. Be careful about this. Questions may be given that exporter enters into a buy contract or a sell contract. Importer enters into a buy contract. It can also be said that bank has taken a bought position or a bank has taken a sold position. So first read the question carefully, whether it is from the exporter's or importer's perspective, buy or sell, or is it from the bank's perspective. Sometimes it is not even given whether it's a buy contract or a sell contract. You have to interpret from yourself only that if just one term, exporter or importer would be mentioned. So this will automatically make it clear to you. An exporter will have a foreign currency receivable. which means he will sell it to the bank. That means bank will buy the foreign currency. So from bank it is buy, to cancel it will be sold. Similarly, from the exporter's perspective, if it is he's selling the currency to the bank and he wants to cancel, then he will take the opposite position. To square off, he will take the buy position then. So here again, Mr. X is an exporter. So it's a sell from Mr. X and buy from bank. He enters into a contract with the BNP Bank to sell US dollar 1 lakh. So exporter sells. So the word exporter is and sell. They are the two terms which are used for each other. Mr. X, exporter, enters into a forward contract to sell. So Mr. X sells here. Otherwise also, if it is not mentioned, Mr. X is an exporter, so he will sell and bank will buy. So his bank is buying 100,000 or 1 lakh dollars on 31st December 2015. So it's a 3-month contract and the rate is fixed at 65.40. However, due to the request of the importer, Mr. X received amount on 28th November 2015. So it was expected that whosoever Mr. X has sold the goods, that person is the importer. He was supposed to be making the payment on 31st December 2015. So then Mr. X would receive those dollars and it will sell it to the bank at 65.40. However, the importer of Mr. X requested him that he wants to make the payment 1 month prior, approximately, that's on 28th November 2015. So Mr. X has also requested the bank to take the delivery of the remittance on 30th November. So this is a case of early delivery. Now, if it is an early delivery, what will happen? Two things will happen. Number one, Mr. X would receive the payment on 28th November. So on 30th November, he'll go to the bank to sell the dollars. So the rate applicable would be 65.22. But because the bank has contracted at 65.40, bank will pay him 65.40. Right? But bank must have covered itself for the contract which it had entered with Mr. X. So the bank must have, on 31st December, bank must have entered into a contract to sell these dollars which it would receive from Mr. X. Now, to honor that contract, bank will also have to enter into a swap contract. Bank is not going to receive any dollars now on 31st December. So bank will have to purchase it from the market, from the interbank. So bank will buy these dollars at ask rate 65.27 plus 15. So the bank will enter into a swap contract and 65.27 plus 0.15. So the bank will enter into a swap with 65.42. So two things will happen because of this. Had everything been normal, Mr. X would have received the dollars on 31st December, which he would have sold to the bank for 65.40. But just because there is an early delivery, two things are happening. First, the bank has to receive the dollars on before that is on 30th November, which it will sell. And for bank, again, bid rate will be applicable. Whereas to cover itself for the contract which it had entered already on 31st December, it will have to buy the dollars. So this is the swap which the bank will enter into. So the bank has to purchase at 65.42 and sell at 65.22. So this 20 paisa loss would be a swap loss which the bank would charge from the customer. Right? So two things are happening here. One, the bank will have to sell the dollars it receives on 30th November at 65.22. And because it had covered its position in the interbank and it is not going to receive the dollars on 31st December, it will buy the dollars from the market at 65.42. So 65.42 minus 65.22, swap loss is 20 paisa, and 20 paisa in per dollar into 100,000. That is a loss of 20,000, which it will recover from the customer. There is another thing which is happening here is that because of the early delivery, there is some outflow of funds from the bank's perspective. Like it will pay Mr. X 65.40, but it will be able to sell the dollars in the market at 65.22. Okay. So there will be outflow of funds early from the bank's perspective. How much? Mr. X would be paid exactly 65.40 as contracted. And the dollars which Mr. X is now going to be giving it to the bank will be able to sell it at 65.2. Therefore, 0.18 into 1 lakh. There would be a outflow of 18,000 rupees from the bank's perspective. On this, bank can charge interest. What rate? At the prevailing PLR, the prime lending rate 18%. So you'll also calculate the interest on 18,000. %. For how many days? From 30th November to 31st December, which makes it 31 days. So whatever this interest will come out, it has to be paid by the customer. 18,000 into 18. So the interest portion is 275.17. So we'll round it off to 275 rupees. So how much will the customer pay extra to the bank? 20,000 swap loss plus 275 as interest. Okay. Right? Let's look at next question now. All questions would be done in similar fashion, carefully and looking at very much carefully that whether the person is an exporter or an importer, bank has entered into a sell contract or a buy contract, or the customer has entered into a buy or sell contract. Basis that the cancellation will be executed. So, for example, 15th January 2015, you are a banker. You have booked a forward contract for $250,000 for your import customer. Delivery on 15th March 2015. So looking at all this from Jan, Feb, March, we have 2 months. Second thing, the customer is an import customer. So an importer needs foreign currency. So he needs the foreign currency. He will buy. That means bank will sell. So the banker has entered into a sell contract to the customer. ask rate would be applicable. Okay. So the ask rate that was applicable for this customer is 65.3450. 15th January, the banker has booked a forward contract for US dollar 2,50,000 for your import customer deliverable on 15th March 2015 at 65.3450. The crux of this line is on 15th March, the bank will sell the $250,000 to the customer at 65.3450. Now, on due date, the customer requests just to cancel the contract. In a sense, he's saying that he's not able to buy these dollars. So, if he is not able to buy these dollars on 15th March, he will have to cancel the contract. He will have to take the opposite position. So, he will sell these dollars to the bank again. So, bank has entered into a sell contract. Bank will purchase. And when bank will purchase, ask bid rate would be applicable. Okay, so bank has sold for 65.3450, but bank will buy at 65.2900. This is on due date. These rates are given for 15th March. He is not asking for any extension for April or May. So these are not applicable for us. Okay. So on this date, quotation is as follows. Assuming that there is a flat charge for cancellation, $100, as well as there is an exchange margin of 0.10%. How much would be the cancellation charges payable by the customer? I hope the question is clear. Looking at once again, we have an importer. Importer would need foreign currency, so he wants to buy. Indirectly, bank sells. So bank has entered into a sell contract, ask rate. But now when he is cancelling, bank will purchase it from the customer. So the ask rate was 65.3450. Bid rate would be applicable 65.2900. Let's do it. Bank will buy $250,000. However, there is an exchange margin of 0.10. In bid rate, the exchange margins are deducted. And if it is ask, add exchange margin. Okay. So it's less exchange margin. (0.10%). So it's 0.06529. (65.29) minus 0.06529. The bid rate applicable is 65.22471. We will round it off definitely. That's up to you. So if you can look at the rates given here, they are up to 4 decimals, right? 2900, 3450. One thing you can do is, firstly, if you look at, ignore the last digit, it's 65.2247. Further, you can round it off in multiples of 0025. Right? But if you do anything like this, you have to mention either the question will specifically ask you how to round off, else you can decide that we are rounding off in multiples of this. So in that case, it will become 65.2250. Or you can leave it as 65.2247. So the bid rate is 65.2250 and the ask rate was 65.3450. There will not be any margin added to this because it has been quoted by the bank to the import customer already. So whatever the margin is, it must have already been included. 65.3450. And the ask rate was 65.3450. This difference customer will pay. Customer bears the loss per dollar. 65.2250 if I take minus 65.3450. The loss is of 0.12 multiplied by $250,000. So the loss to the customer would be 30,000 rupees. Okay. Understood? 15th January 2015, the banker has booked a forward contract for how many dollars? 2,50,000 for the import customer. So the import customer was asking for $2,50,000. Bank was selling $2,50,000 at 65.3450. But now when he is requesting on due date to cancel the contract, bank will buy from the customer at bid rate 65.2900. So opposite position will be taken to cancel the contract. So bank will buy which it had sold. So the sell rate is 65.3450. Buy rate would be 65.2900 less 10.10% margin. So because this buy bid rate is less even after 2 months, therefore the customer will stand to lose 30,000. There is another thing mentioned here. There are flat charges also for the cancellation, which is rupees 100. So the cancellation charges payable by the customer would be loss 30,000 and plus flat fees or flat charges 100. So the total amount paid by the customer would be 30,100 rupees. Okay. Let's look at one more similar question. Suppose you are a banker, export customer, $100,000. Forward sale contract for 2 months. Sale contract. So if you are an exporter, you have foreign currency receivable. So you will sell to the bank. Okay. So this sale contract is from the customer's perspective here. So you are a banker and your export customer has booked a sale contract for 2 months. When the customer is selling, bank is buying. So the bank has agreed to buy at 65.2052. Sorry, 62.52 bid rate. And the bank will also simultaneously cover itself in the interbank market at 62.5900, which means whatever the currency bank has receiving from the exporter, for which bank is going to pay him 62.52. For the same currency, 100,000, bank will not leave itself unexposed. Bank will cover it and will sell it in the interbank market at 62.59. So now what is bank expecting? After 2 months, the exporter will bring in $100,000, and which bank will sell in the market at 62.59 and pay the customer 62.52. So bank as such is thinking about earning 0.07. Okay, 52 minus 59. So bank was thinking that it will get a profit of 7,000 in this transaction. This will happen, everything goes smoothly, but on due date after 2 months, customer is saying that he wants to cancel the contract. But he's also requesting extension by 1 month. So first let's look at the cancellation. Bank was buying, now bank will sell. Okay. So when bank sells, what rate is applicable? Ask. So bank sells at ask rate after 2 months. So these are the rates after 2 months, 62.7200. There is also an exchange margin of 0.10% again on buying as well as on selling. So when bank says that I want 62.72, it will add the margin of 0.06272. 62.7200 plus 0.06272. So bank will now sell that to the customer at 62.78272. So once again, we are not taking the fifth decimal, we are taking 4. Besides, you can round it off to 62.7825. If you're rounding off in multiples of 0.0025. Okay. So this is the ask rate. So the cancellation charges which the customer will pay is bank will sell the customer at 62.78 and bank will buy at 62.5200. So first thing that will happen is this cancellation charges. There is no flat charges here. $62.7825 minus 62.52. So per dollar, he has to bear 0.2625 loss to the customer. He is an export customer. So he was selling at 62.52, but now because he is cancelling, he has to buy at 62.7825, which means he has to bear a loss of 0.2625 per dollar, and his total loss will become into $100,000, which is 26,250. Okay. Besides this, he's also requesting you for an extension by 1 month. So what he's saying is that he wants to actually sell the dollars after 1 month. So he's not expecting to receive the payment after 2 months, but he's expecting to receive the payment after 3 months. So he wants an extension by 1 month. So if a customer wants to sell dollars after 1 month, the bid rate would be applicable. Bank would purchase, so bank would pay him 62.64, but again there is a margin of 0.10. So let's look at this, how we present this question. Forward contract for US dollar 100,000 cancelled by a exporter. Contract was 62.52. So the cancellation charges bank will sell at 62.72. This can become a working note. 62.72 plus margin, so 62.7825. You can call it a working note 1. Ask rate, add margin, round off in multiples of 0025. So 62.7825. Bank will buy at contract price 62.5200. Loss to the customer per dollar. Total loss 26,250 rupees. Price for extension of contract after 1 month. Bid price or bank will buy at 62.6400. Less margin 0.10%. So it's 0.06264. $62.64 minus 0.06264. The rate that would be quoted to him is 62.57736. Once again, round off. $62.5775. Rounded off in multiples of 0.0025. I hope this solution is clear. So two things are happening. In the first question, there was only cancellation. So in a very simple layman terms, you can understand the concept like if the customer wants to cancel a buy contract, he cannot simply say, I want to cancel, he will have to sell. And if the customer says, I want to cancel the sell contract, he cannot simply sell, he will have to buy also. Okay. So he has to take the opposite position, and the exchange difference, whatever is coming out to be because of it, that if it is a loss, the customer has to bear it. And there can also be flat charges also for the same. Further, he may also request an extension. If he requests an extension, he may get a new quote for that period, depending upon whether he is an exporter or an importer. An exporter will have a bid rate, an importer will be, ask rate would be applicable. Once again, in bid rate, the margin is deducted so that the person will get further less. The exporter will get less amount. Whereas at the time of ask, the exchange margin is added so that the importer has to pay more to the bank. So margins are charged by the bank. So here there was a simple case of cancellation. So this was a case of import customer. So an importer was asking for the dollars. So he's saying now I don't want the dollars. He'll have to buy the dollars, right? He will have to buy still at 65.34, but he can sell it at 65.29. Nothing else here. In 28, there was again an exporter who wants to cancel. So exporter was selling. He's saying now I don't want to sell. Okay, you don't sell, but you'll have to ask for it. So if you are not selling the dollars now, you have to sell and buy. So 62.72. You have to take the opposite position. You were selling, now you're refusing to sell, you can take a buy position and the position will be squared off. So ask rate would now be applicable. But here, he's not just saying that I want to cancel, he's also saying that I want to extend the contract by 1 month. So we need to give him a new quote which would be applicable to the exporter after 1 month. Spot rates were given, 1 month forward rates would be given. So exactly after 2 months, we'll not just cancel his contract, but we'll also give him an extended price for the extension of the contract by 1 month. So after 1 month, 1 month forward rates would be applicable, which are given. Once again, bid rate would be applicable because he is an exporter. So he will come and sell the dollars at 62.64. But if we consider the margin, 62.64 minus 0.10%. That answer you can round off in multiples as you think fit, but you will mention in the solution that what method you are using to round off the decimals. Let us look at one similar question again. You have an importer. What would an importer do? Importer would have foreign currency payables. So our importer has foreign currency payables. Since he has foreign currency payables, he would want to buy the foreign currency. I'll write foreign currency XC. So he goes to the bank to buy the foreign currency. Ask rate would be applicable. So bank is selling the foreign currency. Bank sells, customer buys. How many dollars? US dollars 20,000. What date of maturity? On 30th October 2010. And he wants to extend the forward contract for a further period of 3 months. So an importer has requested his bank to extend the forward contract for US dollar 20,000, which is due on maturity on 30th October 2010 for a further period of 3 months, and he is agreeing to pay the required margin money for such extension of the contract. So once again, just like the previous question, this is also same, but there we had the exporter, here we have an importer. Two things are required to cancel the contract. Due on 30th October and 2 to quote for the extended by 3 months. Okay, 2 things are required again. One is to cancel the contract and second is to give a quote for the extension by 3 months. To cancel the contract, there is only one way: you take the opposite position. Customer was asked, wanted to buy, now he'll have to sell. Bank, we were saying, bank sells. So from the bank's perspective, bank sells, now bank will buy. Okay, so that when the customer has to sell, bank has to buy, bid rate is applicable. Or we have just seen in the previous slide, I just wrote here, what rate is applicable? Ask. So to cancel, bid rate would be applicable. So the contracted rate was 42.32. It was expected that we will demand from the customer. Ask was 42.32, but now the bid rate is on the spot, that is on 30th October 2010. Bid is 41.50. Is there a margin money? Yes, there is margin. And there is a different margin at buying and selling. At buying, it's 0.75%. And for ask, it is 0.20%. So there are different margins also, while at the time of bid and at the time of ask, 2 different rates of margin is applicable. So you'll have to be careful that in bid, you will subtract 0.075%, whereas in ask, you will add 0.20%. Okay. So on 30th October, what are the spot rates? 41.50/41.5200. What is applicable to us? Applicable to us is 41.50. On 30th October 2010, cancellation rate or bid rate is 41.500 less margin at the rate of 0.075%. Minus 0.031125. It's 41.468875. You will round off 41 point. Either you can have 41.4675 or you can have 41.4700. Once again, rounding off in multiples of 0.0025. Now, if we look at 88 from 75, it's 8 plus 5, 13. And from 88, it is 12. So we'll go to next higher multiple. 41.4700 will become the applicable rate. Okay. So be careful in choosing your rounding off figure. Which one is closer, you will round off to that. However, even if you look at this 7.5, if you make it 41.4689, then also 41.4700 will be the answer. Right? So the bid rate is 41.47 and the ask was 42.32. Loss to the customer. $0.85 rupee per dollar. Right? Look at this again. Importer has requested the bank to extend the forward contract for US dollar 20,000 due for maturity on 30th October 2010 for a further period of 3 months. So when a customer requests for extension, two things happen. One, the original contract has to be cancelled and a new quote for the extended period has to be given. So the first thing is we will cancel it on 30th October. Since he is an importer, he needs foreign currency. He is going for a buy of foreign currency or he wants to ask foreign currency. Therefore, ask rate was applicable. That means bank was selling foreign currency and customer was buying foreign currency. Now he's saying, no, I don't want to buy. Okay, then you can sell, buy and sell. So he will sell at bid rate, which is 41.50 to square off the position. So when first ask rate was applicable, now bid rate would be applicable. Alternatively, customer was buying, now he will sell, or bank sells, now bank will buy. So bid rate is 41.50 less margin of 0.075 and we get to the rate of 41.4700 after rounding. So customer has to pay 42.32 and he will receive 41.47. Therefore, 0.85 is the exchange difference which he has to bear as a loss per dollar. And since he has contracted for $20,000, 20,000 into 0.85 is 17,100. So 0.85 multiplied by $20,000. Total loss due to cancellation, 17,000. Right? Next part. We have to give him a quote. So the first part, cost to the customer for extension of the contract and the rate of new forward contract. So in respect of extension of the forward contract, the original contract is cancelled and the cost to the importer for this is 17,000 rupees. The rate of new forward contract. So what will happen? The customer wants to sell. Importer will sell after 3 months. So ask rate after 3 months is required. So bank will sell. Importer will buy after 3 months. ask rate would be applicable. When the importer will be in need of this money after 3 months. So he will buy, importer buys or bank sells. That means ask rate is applicable. What is the ask rate? Now, instead of being given the swap points, or instead of be receiving the forward premium points, anything like that, or the forward rates, what is given is the premium percentage, 0.93%. Okay, so the 3 months premium is, it is 0.87% or 0.93%. That means dollar is at premium. So we will add 41.52 and 0.93% of that. So ask rate that would be applicable is 41.52 plus premium at the rate of 0.93%. So 0.93% of 41.52 comes out to be 0.3861%, 6136. 41.906136. Once again, you can round it off to in multiples of 0.25. So instead of 61, we can have 41.9050. Okay. So the rate of new forward contract would be 41.9050 rupee per dollar. Right? The importer has requested the bank to extend the forward contract for $20,000 due on 30th October. Once again, there is an importer who needed money. How much? $20,000. He's canceling that contract. So he's saying, I don't want to buy. So he will have to buy, but he'll have to sell. Okay. To square off the position, the customer will now have to sell, which means bid rate would be applicable together with a margin of minus 0.75%. So we calculated 41.5 minus 0.075%. The bid rate comes out to be 41.468875, rounded off to 41.4700. So the customer was supposed to buy at 42.32, which now he will sell at 41.47. He will incur a loss of 0.85 rupee per dollar. So on $20,000, his total loss on cancellation would be 17,000 rupees. He will have to bear that. Besides, a new forward rate would be offered to him for getting his contract extended by 3 months. So what is the quote after 3 months? Spot is given. 3 months premium is given in terms of percentage. So we will add the premium amount 0.93% to the ask. Had it been bid, it would have been 41.50 plus 0.87%. Remember, premium would be added whether it is bid or ask. However, exchange margin that the bank will take, it will be deducted from the bid and added to the ask. If it is premium, it will be added to bid and ask. If it is discount, it will be deducted from bid and ask. But if it is margin money which the bank is charging, it will be deducted from the bid and added to the ask. So when bank will ask money for the foreign currency, it will ask the ask price plus the margin. And while making the payment, when the customer is selling that currency, bank will pay the bid price less the margin. Okay. Same margin can be applicable for both bid and ask. Sometimes it can be different also, like in this question. There are different margin money for buying and selling rates. 0.075% and 0.20% respectively. Okay. So first we had to calculate what is the cost to the customer or the importer in respect of the extension. For that he has to cancel. So he was supposed to ask, now he will have to sell at bid. And the new rate would be applicable. So because he is an importer, he needs an ask rate. On 41.52, we will add 0.93%. Right? Let's move on to one more similar question. The more you will practice with these type of questions, the more clarity you will have. Here, the question is specifically saying that rates to be rounded off to 4 decimals in multiples of 0.0025. So in case question doesn't mention anything about how you are going to round off the digits, you may yourself assume the same thing, that we have rounded off the rates up to 4 decimals in multiples of 0.0025. Let's look at this one question here. Suppose you as a banker entered into a forward purchase contract for US dollar 50,000. Banker has entered into a purchase contract. Okay, so banker buys, customer sells. On 5th March with an export customer. So when we said you as a banker entered into a forward purchase, bank buys. So when bank buys, automatically customer sells, which also means bid rate applicable. Right? What is the applicable rate? It's the bid rate. Bank buys, customer sells, bid rate. How many dollars? US dollar 50,000. When? On 5th March for 3 months. At what rate? 59.60. So bank has entered into a contract with the customer where the customer said that I'll be paying $50,000 to the bank, and in return bank has to pay me 59.6 rupee per dollar. So 50,000 into 59.6. So on the same day, you also covered yourself in the market at 60.6025. Now, let's say you are the bank here. Exporter is here. So exporter will pay you dollars. So bank also said, I will also cover myself. That means on the same day, whatever the dollars it will receive from the customer, it will sell. Bank has also entered into a sell contract. So 60.6025. Indirectly, bank has got a arbitrage position here. Bank is receiving from the customer at 59.60 and selling to someone else at 60.6025. So almost 1.0025 is what the bank is going to earn. Clear? Bank has entered with the customer, the exporter, and therefore it has covered itself in the market at 60.6025. Now, when I'm saying bank buys, that means customer sells, bid rate is applicable. The same information can be received from just one word, that he's an export customer. So an exporter will definitely receive foreign currency, which he will sell. So when the customer is selling, bank will buy. Now what happens actually, that is, this agreement was done on 5th March, 3 months. So from 5th March, when you count 3 months, it's 5th June. So the contract was for 5th June. But what happened is, on 5th May, the customer comes to you 1 month prior. So whatever he is requesting, he is not requesting on the due date. He is requesting on a date prior to the due date. 1 month prior, that is on 5th May. The customer comes to you and he requests extension of the contract to 5th July. So indirectly, he is coming 1 month prior to cancel, and extension is also demanded for after 1 month. Okay. So he's coming on 5th May. So the extension will be required after 1 month of the contract date. That means 5th July. So new rates will be offered for 5th July. Cancellation is demanded on 5th May. And we have rates applicable on 5th May also, 5th June and 5th July. All the 3 dates, we have the spot rates mentioned. There is also a margin of 0.10% whether on buying and selling. So you have to determine the extension charges payable by the customer and the new rate which will be quoted to the customer. So if you look at this question, it is almost similar to the previous one. However, this time the customer is not saying this on the due date, but he is requesting on the, not on the due date, but 1 month prior. So on 5th May, the customer comes to you and requests extension of the contract to 5th July. On this date, 5th May, the quotation for US dollar in the market is as follows. Spot, that means on 5th May, 5th June and 5th July. We can see that the rates are constantly increasing, so dollar is at premium here. Right? Now, how will we proceed? So first step would be to cancel the contract. Bank buys, so bank will sell. Customer sells, customer has to buy. Ask rate would be applicable, right? So for $50,000, on 5th May, he wants to extend the contract by 1 month. Bank buys, so bank will now sell at 1 month forward from 5th May to 5th June. Okay, so 1 month forward is 5th June. And as we say, bank will sell. Ask rate would be applicable. 59.2300 and 2425. So 59.2425. 59.2425. Plus there is a premium of 0.10%. 59.2425 plus 0.05922425. So the ask rate is 59.3017425. Rounded off. Here it is specifically mentioned up to 4 decimals. In multiples of 0.0025. So 59.3025. Okay. So either I could have made it 59.3000 or 59.3025. Now 3025 is closer to 17. 00 is not closer. Okay. Ignoring all this. So this is the rate applicable. Now the loss or gain to the customer. It can be gain also sometimes, right? Let's see. So the customer is selling at 59.60 and customer buys at 59.3025. So if you look at this rates on 5th May, these are the spot given. So from 5th May, 5th June, 5th July, we can constantly see the price of dollar increasing 59.132363, 59.142464. In this period, the dollar is at premium. Right? But the rate that was quoted to him on 5th March, that was 59.60. So the price of dollar has fallen from 5th March to 5th May. In these 2 months, the dollar was at discount, right? In these 2 months, from March till May, the dollar was at discount. But from May to July, it is at premium. So just because the dollar was at discount from March to May, what happened is the customer who had said that he will be exporter, who was selling at 59.60, is buying at 59.3025. So there is a gain to the customer. How much? 59.60 minus 59.3025. The gain to the customer is $0.2975. And for how many dollars the contract is? 50,000. The gain will pass on to the customer. Why? Because he has given the notification for the cancellation prior to the due date, not after the due date. $50,000 into 0.2975. So the gain to the customer is 14,875 rupees. Okay. Gain due to the cancellation of the contract to the customer is 14,875 rupees. I hope there is no doubt. Once again, let's look at this. You as a banker entered into a purchase. That means the customer was selling $50,000 for 5th June because he entered into a contract on 5th March for 3 months. So from March, April, May, June, that contract was on 5th June for selling $50,000 at 59.60. So the customer was supposed to sell $50,000 and receive 59.60. But on 5th May only, he says that he is not able to make the payment for dollars on 5th June. He will not be able to convert the dollars into rupee on 5th June, but he needs an extension till 5th July for 1 month. So on 5th June, May only, we will allow him to cancel the contract and offer him a new date that would be new rate for 5th July, 1 month after the original contract date. So firstly, as the customer was selling, he will have to buy the dollars on 5th June. So ask rate would be applicable. The rate was 59.2425. After 10%, 0.10% margin, the rate was finalized at 59.3025. Now the customer is selling at 59.60 and buying at 59.30. So the customer stands to gain 0.2975 rupee per dollar. And on $50,000, it becomes 14,875 rupees. Okay. Next, second part. Determine the extension charges payable by the customer, which we have done, and the new rate quoted to the customer. So new rate has to be quoted to the customer. So on 5th July, he will sell his $50,000. Bid rate would be applicable. This is the rate. But as we have a margin, less margin at the rate of 0.10%, which is equal to 0.05963. It's 59.57037. So once again, when you round off up to 4 decimals in multiples of 0.0025, what will you get? Final quote, 59.57. Even if I make it 04, so it will be 00. Okay, so it's 59.5700. This will be the new quote that would be offered to him. You can ignore this 7, you can make it 4. Now 5704 rounded off in multiples of 0.0025, 59.5700. Right? Okay. I hope concepts are clear. So there can be cancellation on the due date. In that situation, nothing is to be done. If the customer is in a buy position, he will have to go for a sell position. If the customer is in sell position, he will have to go for a buy position. Now, whenever the customer is, let's summarize these points. I'll take up a blank sheet for that. So cancellation on due date, only cancellation. You can look at it from the customer's point of view, or you can look at it from the bank's point of view. So if the customer says cancellation is by the customer, if the customer has a buy position, he will have to take a sell position. So buy for customer means ask, sell means bid. Right? Cancellation on due date. Simply, if the customer has a buy position, he will have to take, to square off, he will have to take sell position. So buy means ask, sell means bid will be applicable now. And if bid is greater than ask or sell is greater than buy, customer will gain. Like it happened in this particular previous example that we just did. Customer was selling at 59.60, but he was buying again at 59.30 something. So he was gaining. If the customer has sell position, to square off, he will have to buy. Customer sell means bid and customer buy means ask. Here again, if bid is greater than ask or sell is greater than buy, there will be gain to the customer. Now, very evidently, the first position will happen if the customer is an importer. Customer wants to buy the foreign currency because he needs the foreign currency because he's an importer. He needs to make the payment in the foreign currency. And this will happen when the customer is an exporter. Cancellation before due date. Same aspect. Everything will be same except we use forward rates. So the customer has taken a buy position. He will take a sell position at a forward rate. If he has taken a sell position, he'll take a buy position at the forward rate, not the spot rate. Here, the spot rate would be applicable. Here, forward rates would be calculated. If margin is to be determined, deduct from bid and add to the ask. Now, not just cancelling, but also asking for an extension. That is also simple. First part in the extensions, questions related to extension will be same. Whether it's a first thing, previous contract has to be cancelled. And then a new date extension contract will be given, just like we are calculating a forward rate for the cancellation if it is before due date. Similarly, you will calculate the rates applicable for the extension. Once again, if the customer is an importer, the ask rates would be calculated for extension. But if the customer is exporter, bid rate would be calculated for the exporter. Right? So this is the summary of what we have just done. Let's do one or two multiple choice questions on this. Then we'll come on to the next question. All right. Just look at this question. A customer with whom bank has entered into 3 months forward purchase contract for Swiss francs 10,000. bank has entered into purchase. Bank will purchase. That means customer will sell. So the customer is exporter. Okay. Customer with whom bank has entered into 3 months forward purchase contract for Swiss francs 10,000 at the rate of 27.25. So for exporter, bid rates are applicable. Comes to the bank after 2 months and requests cancellation. On these dates, the rate prevailing are this: Swiss franc rates today and 1 month forward. What is the loss or gain to the customer on cancellation? Yes? Anyone? Bibu, Leela? Quickly? You are an exporter? You need to sell Swiss francs. Okay. When? Contract is for 3 months. Cancellation request after 2 months. That means it is an early cancellation. Before due date. So we will use 1 month forward rates. Exporter was selling. To square off, he will have to buy. Ask rate would be applicable. So what are we interested in? 1 month forward ask rate. What is the 1 month forward ask rate? 27.52.
There will be a loss of 2,700.
Yes, loss to the customer INR 27. D is the right answer. Good. Very well done. So to just complete this, customer is selling at 27.25 and going to buy at 27.52. So there is a loss of 0.27 per Swiss franc. 10,000 into 0.27 is 2,700 rupees or Indian rupee. INR. Good. Let's do one more. Look at this. Once again, 3-month forward contract. You as a banker has entered into a 3-month forward contract with your customer to purchase Australian dollar 100,000 at the rate of 47.25. However, after 2 months, the customer comes to you and requests cancellation of the contract. And on this date, so once again, just like the previous question, same here. 3 months forward contract, which is cancelled after 2 months. So 1 month forward rate would be applicable, not spot. Secondly, you as a banker has entered into a 3-month forward contract from your customer to purchase Australian dollar at the rate of 47.25. Is the customer an exporter or importer?
It's an exporter, ma'am.
Customer is exporter. Good. Good. Why? Because bank is buying. Bank has agreed to purchase. If you read it properly, you as a banker has entered to purchase. Okay, this is a clause. Just ignore it. So you as a banker has entered to purchase. So bank is purchasing, customer is selling. Customer will sell when he is an exporter. So to cancel, the customer now needs to buy. So once again, same question exactly, ask would be applicable. But what was the difference in this one and previous one? Here
In
we
that
have
one,
said
we have the
customer.
customer. Here we are banker.
Here it's a bank. Here we are saying customer, and here it is the banker. So customer sells, bank buys, the customer sell, the customer will have to buy to cancel, and 1 month forward buy rate for customer is needed.
There will be gain of 27,000.
Let's see. 52. This would be the rate applicable. So customer sells at 47.25, but customer buys at 47.52. Gain or loss?
Wherever. Yeah. And for customer, it will be loss to customer.
Loss to the customer. Why did you say gain?
I thought it has to sell after 2 months.
See, bank has entered into purchase. So bank has to sell after 2 months. If you look from the bank's perspective, bank has done what? Purchase now. So to cancel, it will sell. And when bank sells, ask is applicable, right? If you look at from the customer's point of view, customer is selling. You as a banker has entered into 3-month forward contract with your customer to purchase Australian dollar. You are entering to purchase, that means customer has entered to sell. So customer is selling, he has to buy. When customer buys, it is the ask. So whether you look at from the bank's perspective, bank entered into a purchase contract, it will have to sell. Customer entered into a sell contract, it will have to purchase. So when bank sells, ask is applicable. When customer purchases, ask is applicable. Right?
Right, yes, he has to take the opposite position, yes.
He has to take the opposite position. Whether you look at from the bank's perspective, bank has purchased, now bank will sell. Or you look at from the customer's perspective, customer has sold, now he will buy. Okay, so 47.25 and 47.52, the difference is once again of 0.27, but now multiplied by 100,000, so it's 27,000. Loss to the customer, INR 27,000, right? These are the cancellation charges which are payable by the customer. Okay. Here also, a customer with whom bank has entered into a purchase contract. Bank has entered into purchase. Had it been a customer which has entered it with the bank into a sale contract, same answer would have come up. So bank purchase is customer sells. And customer will sell when he's an exporter. So just the language was a little different, but the situation was exactly same. Okay. All right, team, we can go for a break, and then after that we'll come on to a question on complete cancellation, swap loss, interest, new contract, total cost. Okay. Any questions so far? Yes. Anyone has any questions?
No question. No.
Oh, all right. So we can go for a 10 minutes break and we come back. here a complete question on cancellation, extension, and where the bank has also covered itself. So let's look at this question from complete perspective. So first important information is there is an importer. An importer has booked a forward contract with his bank on 10th April for US dollar 200,000. Due on 10th June at 64.40. So the very first thing that we come across is that we have a importer. Importer needs foreign currency, so he wants to buy foreign currency. So bank sells foreign currency at 64.40 ask rate, right? Bank sells. But bank has also covered itself in the market at 64.28. Bank has also covered. So bank buys at 64.28. So it's not that when a customer comes to sell or buy currency, bank says, okay, I have a lot of currency with me, you can buy or sell anything. Bank generally gets it arranged and it keeps a fixed exposure in a foreign currency. And if there is any customer who's demanding, it generally will cover itself in the interbank. So importer has come to the bank and importer wants to buy the currency. The bank will also buy it from interbank and will hand it over to the customer at a higher rate generally so that there is a profit to the bank in the entire transaction. So the bank has covered itself in the market at 64.28. So bank will buy from interbank at 64.28 and will sell to the customer at 64.40. This is what was supposed to happen on 10th June if everything was perfect. The exchange rate for dollars in the interbank market on 10th June and 13th June are as follows. Spot on 10th June and on 13th June. Spot June, spot then July forward, August forward, September forward. So these are the rates which are mentioned on 10th and 13th June. Okay. Exchange margin is 0.10%. Interest will be charged at 12%. And on 14th June, so we can take the rates on 13th June, the importer has come for extension of contract with due date on 10th August. Rates are to be rounded off to 4 decimal points in multiples of 0.0025. On 10th June, bank swaps by selling spot and buying 1 month forward. Okay. Calculate the cancellation rate, amount payable on $200,000, swap loss, interest on outlay of funds, new contract rate, and total cost. So the question is to be done in 6 parts. Before I explain anything further, we have done a lot of questions on cancellation. Let's do this one also on cancellation. So when is the customer coming for cancellation and extension? On 14th June. So once again, we'll go by our complete procedure that we have followed. So it was an importer. Importer was supposed to buy. Now the importer will sell. And when importer will sell, bid rate would be applicable. This entire thing will happen on 13th June's rate on 14th June. So we'll use the rates for 13th June. Right? Simple, clear?
Clear, ma'am.
Okay. So importer was supposed to buy foreign currency. Now to cancel, he has to sell. He's coming on 13th June, so he will sell on 13th June. Applicable rate for bid US dollar on 13th June, 63.6800. So first part, what is the cancellation rate? Cancellation rate So importer is going to sell, bank buys at 63.6800. So it's a bid less exchange margin at 0.10%. 63.61632 rounded off in multiples of 0.0025. So if I simply round it off to 4 decimals, it becomes 63.6163. But I have to round off in multiples of 0.0025. Now, if I make 63 as 50, let's take it these last two digits. Ignore this. If I take 63 as 50, or I can take it as 75. If I take it as 50, I am subtracting 13. The difference is of 13. But if I take it to 75, the difference is of 12. So this is closer, 63.6175. This is the rate applicable to the customer. This is the cancellation rate. Second part, amount payable on $200,000. So we are trying to calculate the gain or loss to the customer on 200,000. Yes.
The difference between spot USD 1 is equal to 10th June and which is given in question, ma'am, which is given spot in June.
Right. So cancellation will be applicable when the customer comes for applying for cancellation.
Yes, ma'am.
So he came on 14th June.
Yes, ma'am.
So we take the opening rate or closing rate of 13th June, let's say.
Ma'am, in the same, ma'am,
Go ahead, please.
ma'am, in the same line, we have spot in June. For 13 June is 63.80. What is the difference between spot USD 1 and spot per June?
Okay. These two things you are saying.
Yes, ma'am.
These are the specific rates on 10th June and 13th June. Okay. Whereas this is the rate for June forward, the 1 month forward, when the June will end. Like you have spot July, August, September, which means forward rates for July end, August end, September end, right?
But at the table, it's 10th June and 13th June given. So it will be for all the table, na? Like 10th June, 10th August, 10th September.
Okay.
And 13th,
No.
13th.
Okay. I'll make this change here. This is applicable here. Okay. And this is applicable here. And even these rates are also for 10th June and 13th June. These are July forwards, August forwards on 10th June. July forwards rates will also change on 13th June. They may change.
Yes, ma'am.
Within 3 days, there can be some movement. So the forward rates can also change within 3 days. Okay. Is it clear?
Yeah.
I'll come back again. Let's say we have 10th June and we have 13th June. So spot USD is given. That means exact rates on 10th June and on 13th June. then spot June is also given. This means June forward. So like another 10-15 days in the month of June are remaining. So if any time in June you want to exercise, this is the price. July forwards. So on 10th June, July forwards was 64.05 oblique something. But on 13th June, these also changed to 63.93. So this somewhere depicts that within next 3 days, we felt that there can be some discount on dollars.
Ma'am, that
It has come
spot given for June, that spot given for June forward is for the whole June. It's not
for the
specific.
whole June. Whole June.
30.
Right. Whereas this is specific for 10th June. This is specific for 13th June. But spot June is applicable for any time from 10th June to till the end of June. And spot June on 13th June is applicable from any time from 30th June till the end of June.
Okay, ma'am. Now it's clear. Yeah, due to this table structure, I thought that it's 10th June and 13th June spot is applicable only for it's 10th June, 10th July, 10th
No.
like that.
Like I say, here he will come that I want to get the contract extended, right? On 14th June, he's saying I want to get the contract extended with due date of 10th August. Even if he's saying he wants the due date of 10th August, but because he's coming on 14th June, we will apply the August forwards from this date.
Okay, ma'am.
Okay. Is it clear? Because
Clear.
the rates for June, July, August, September, all the forward rates have also changed between 10th June and 13th June. Okay? Right. So
Why
the first
are
thing.
there? I have a question. Ma'am. Why are there these the rates are given twice for the month of June, July, August, September? Then why are two rates given?
Because the original contract was for 10th June, right? But the customer did not show up neither on 10th June, neither on 11th, 12th, neither on 13th. So let's say on 14th he showed up using the rates which are given on 13th June. Okay. So that is the date when he actually came up. This is a question when the cancellation and extension was demanded after the due date, not on the due date. So if he is asking for a forward contract for the month of August, the rates which are applicable on 13th June for August forwards would be applicable, not the rates which are available on 10th June, which were there on 10th June. Is it clear now?
Yes, got it. Yes, yes.
Okay. The customer is approaching on 14th June. Let's say he's approaching on 14th June or 13th June. So rates which are applicable for everything will be on 13th June. The significance of 10th June is only one. Bank will incur certain losses because the bank has covered itself, its position on 64 at the rate of 64.28. Bank has agreed to buy at 64.28. So he will have to buy, but he will have to sell on 10th June itself. So when bank will sell on 10th June, the rate applicable to bank will be 63.80. So this will be a loss or outflow of funds for the bank because it will buy at 64.28, but it will sell at 63.80. Okay. The significance of 10th June will be this because the bank has covered itself in the interbank market by buying at 64.28. But customer did not turn up to take that money, right? Importer did not come up, did not show up on 10th June, whereas the bank had covered already, so it had bought at 64.28. So it will have to sell those 64.28 at 63.80. This is the significance of 10th June here. And also on 10th June, bank doesn't know when the customer will turn up. So bank will cover itself. It's saying here on 10th June, bank swaps by selling spot and buying 1 month forward. So bank here, we'll talk about it. Okay.
Okay.
Let's not confuse. Let's go one by one. So the very first thing that is asked is what is the cancellation rate? Simple. Cancellation rate means importer. Just write these words. Importer, right? Importer has to buy the currency. To cancel, it will now sell. If the importer sells, it means bid rate is applicable. Okay? Simply. And on what date? Because he's coming on 14th, the cancellation will happen on 13th June's rate. So let's look what are the bid rate on 13th June, 63.6800, and deduct from this the margin of 0.10%, 63.61632, rounded off till 63.6175. Done? First part done? Let's look at the amount payable on $200,000 by the customer. Loss or gain to the customer. Amount payable by the customer on 200,000. Payable, because here it will be payable only. He did not come to cancel the contract before the due date. On the due date. He has come afterwards. Amount payable on $200,000. So the customer buys, or we can say the bank. He was an importer. So the bank had agreed to him to sell at 64.40. So bank was selling at 64.40. Bank will buy at 63.68, rounded off after margin. So bank sells at 64.60 and bank buys at 63.6175. Right? Importer wanted to have the money. So bank is selling the money to the importer at 64.40. But now because he is cancelling, so bank is buying it back from the customer at 63 point something. Technically 63.68 minus 0.10% margin rounded off. So the gain to the bank 64.40 is more than 63.68 something minus 63.6175. Team, you will do one more thing here. This should also be written till 4 decimal places only, because we are rounding off till 4 decimal places. So even if it is a 00, please do write.
Ma'am, in second amount payable it on $2 lakh. Bank sells at 64.4, no, because the contract was on 64.4.
Sorry, I wrote credit at 64.6. Right.
Okay.
Yeah, 64.40. I'm typing in the calculator 64.40, just by mistake I wrote that. Okay, 64.40 minus 63.6175. So the loss is 0.7825 multiplied by 200,000. So the amount payable loss to the customer or amount payable is this, whatever the figure this comes here, multiplied by 200,000. 156,500 rupees. Okay? Clear? Second part?
Clear, ma'am.
So since we have done a lot of questions on cancellation, I'm sure cancellation is very easy for you now. So the loss is 0.7825 per dollar multiplied by $200,000. So it is 1,56,500 rupees. Okay, first part and second part, I hope there is no confusion. Simply cancellation.
Yes,
Cancellation will happen when the customer will approach. Customer approached on 14 June, so the rates applicable on 13 June will be taken, not on 10th June. So first thing is clear that cancellation rate is 63.68, and after deducting the margin and rounding off, it comes out to be 63.6175. Second, amount payable on $200,000. So the customer has to buy at 64.4 and sell at 63.68. Oppositely, bank sells at 64.4 and buys at 63.6175. So the amount payable by the customer is 200,000 into the difference, which is 1,56,500. Let's now talk about swap loss. Now, what is happening here in swap loss? First, let me explain it to you. Swap loss. So what has bank done? Bank has covered its position. By buying 200,000 USD at the rate of 64.28. Right? Clear? Bank has bought it at 64.28. Bank needed to sell it to the importer, right? So where will the bank get the dollars from? Bank bought it in the open market at 64.28. Now, the importer did not turn up on 10th June. So bank does not have that money to buy. Bank has already bought it and customer is not asking to take it. So the bank will have to sell it on 10th June in the open market. So bank will sell it at 63.80. Here the bank is not selling to the customer. Bank is selling as a customer in the interbank market. Did you understand? Bank has covered its position by arranging the dollars. So bank already bought $200,000. What will bank do with this? Nothing. Why? Because the customer has not come to the bank to take the money, to take the dollars. So what will bank do with it? Bank will have to sell it in the spot market on 10th June. So bank will sell these dollars which it had already covered at 63.80, right? But the customer may come up tomorrow, day after tomorrow, anytime the customer can come up to take the money. So bank will cover its position once again, buying 1 month forward. Okay. So the dollars which bank covered itself on 10th June, that it will sell at 63.80. But just in case the customer comes up after 2 days, 3 days to buy those dollars, bank will again cover itself to buy those dollars in the 1 month forward market. Swap loss. This is the swap loss. So first you have to sell at a lower price, 63.80, and then you have to buy at higher price, 63.95. Okay. So how much is the swap loss? Third point. On 10th June, bank swaps its position by selling spot. I have given you the logic why bank will do it. Although the question is clearly mentioning that bank will enter into a swap arrangement whereby it's selling at spot. Selling at spot means 63.80 and buying 1 month forward. 1 month forward June. On 10th June this is happening. So the rates applicable are 63.80 and 63.95. So bank sells at 63.80. Bank buys at 63.95. So technically this is 63.80 a swap loss of 30,000. 0.15 multiplied by 200,000. Okay. The next thing that we will calculate is interest on outlay of funds. Now there is small difference. This was a swap arrangement. The bank has sold at 63.8 and bought at 63.95 for swap. But in truly speaking, if you look at this rate, bank covered itself at what rate? 64.28. So bank is buying at 64.28 and selling at 63.80. Okay. How much is the outflow of funds? Interest on outflow of funds? 64.28. And it was able to sell at 63.80. So the cash outflow, this is again on 10th June. $0.48. Outflow of funds. Per dollar is 0.48. Total outflow $96,000. $96,000 is for how many days? We'll calculate interest at the rate of 12% on this. Okay, so he's asking for the transaction on 10th August till 10th August. So from June to 10th August, it's approximately June, July, and August 20 and 31, 51 and 10, 61 days. So approximately 119.25 is the interest. Let's calculate. So rupees 1925. Okay. That is the interest on outlay of funds. So swap loss is 30,000. Amount payable on loss is 150, 500. And interest cost comes out to be 1925. Next, fifth part is asking new contract rate. So what would be the new contract rate here? New contract rate. The new contract rate would be for 10th August. But when is it demanded? On 14th June. So the rates applicable for August forward on 13th June would be applicable. So new contract rate would be, again, he's an importer, so he needs to buy, and ask would be applicable. This would be the new rate. So August forwards would be 64.2500. $64.2500. Here again, margin would be applicable. The new rate would be 65.31525. Again, rounded off till 4 decimals in multiples of 0.0025. So the new rate would be 65.3150.
Okay. Ma'am, will we take a interest on outlay of fund for only the 10 to 13 3 days difference, or for the that we have calculated whole day 2 months and 1 day?
No, we will calculate specific days. So from 10th June till 10th August. I have taken 20 days of June, 31 days of July, and 10 days of August.
Okay, ma'am. Ma'am, because the new contract has been made on 13th of June, and
So new contract rate, the interest is, the payments have been made by the bank from the very beginning. No, on 10th June, the bank entered into the contract. So the outflow of funds for the bank is from 60 at the rate of 64.28 on 10th June itself.
okay, but interest shall be calculated for the date when the fund has not been means when the option has not been operated, no.
You can take from 13th, you make your assumption and your note if you want to do that. Okay.
Okay. Because it's a swap on 30th last 10th
Swap
of.
is on 10th June.
So we will make calculate from swap to the new date, contract date.
10th August till 10th August, right? Okay.
Okay, ma'am.
And last part, what is the loss to the, what is the total cost? So new contract rate has been arrived at, is it clear? 65.3150.
The new contract rate would be 64.25. You wrote
Sorry, 64.
65.
64. Okay. So sorry. 64. I have wrote it wrongly. 60. There will be some slight difference. Let me check. 64.25 plus 0.06425. So this comes out to be 64.31425. Now round off 64.3150. Thank you for pointing out that. So the new contract rate is 64.315. Okay. Last, it is asking you to calculate the total cost. So in calculating the total cost, you will add all the three figures, 1,56,500, the cancellation charges, plus the swap loss to the bank, 30,000, plus the interest cost. Okay. So the total cost would be 1,88,425. Okay. Rupees or INR 188,425. Let's quickly discuss it again let's have a recap of this question. There is an importer who has booked a forward contract with the bank on 10th April for 200,000 USD and the rate quoted to him is 64.40. That means the bank will sell $200,000 to the importer at 64.40, which bank has already covered itself and bought at 64.28. Now what happens on 10th June, the importer does not turn up. And so the bank which has covered its position at the rate of 64.28, it has bought the dollars, it will sell in the open market at 63.80. You may apply the margin here also, 63.80. So this will be a outflow of funds to the bank, buying at 64.28 and selling at 63.80. This loss will meet a total outflow of 96,000 and interest on 96,000 will be calculated at 12% from 10th June till 10th of August. Another thing bank will do on 10th June is when the customer does not turn up, it will do a swap, it will sell the dollars it had bought for 64.28 at 63.80, but will again buy for the customer at 1 month forward. So it will buy at 63.95. So buying at 63.95 and selling at 63.80. This would be a swap loss of 15 paisa per dollar, 200,000 into 15 paisa. 30,000 would be the swap loss to the bank. The customer now comes on 14 June that he wants to cancel this and extend it for 10th August. So on 13 June, when the customer comes to cancel, that's very simple part. Customer is an importer. Importer was buying. Now he will have to sell on 13th June. So bank will buy at 63.6800 less margin 10%. So the first part 63.6800 would be the rate, less margin and rounded off. So customer will have the cancellation at 63.6175. Amount payable, customer is buying at 64.40, selling at 63.6175. There is a loss to the customer of 0.7825 rupee per dollar multiplied by $200,000. The total loss to the customer on cancellation is 156,500. So cancellation rate 63.6175. Loss on cancellation of $200,000, 156,500. Swap loss 30,000. Interest 1925. Any doubt here or is it clear so far? The new contract rate would be applicable for 10th August, but the rates that are given on 13th June will apply. So a new rate has to be quoted again for the importer ask rate 64.25. On 64.25, we will add the margin of 0.10%. So the new rate that will be quoted to the customer is now 64.3150. So this is the new contract rate. Finally, what is the total cost to the customer? The customer will have to bear any cancellation loss, swap loss, as well as the interest on outlay of funds. So together he has to bear a cost of 188,425 South. Okay? Right?
Right.
We'll do one more question.
These questions are not uploaded, I think.
This is assignment 3. I'll ensure that they get uploaded. Don't worry. Okay. In the meantime, I would want you all to go through all the illustrations and questions which are given in your study material thoroughly. Okay? If you have any doubts in that, we can take up.
Okay.
Please try to complete each and every question and illustration on study material. Okay, we'll do one more question and I have MCQ based on this. Your bank's London office has surplus funds to the extent of 500,000 USD for 3 months. So this is a type of question where you will want to make an investment. Okay, so here we talk about where to invest. It generally does happen that you may have some surplus funds. You don't keep it with you. You don't park it with yourself. You make these as investment in some place. And where do you make the investment depends upon which is most beneficial. So you will optimize your funds by investing them at that area, on that market or that place where they give you maximum returns. So we are going to calculate this. So your bank's London office has surplus funds to the extent of $500,000. Now you have 3 options. You can invest in London, New York, or Frankfurt. All the 3 countries or places are giving you different rate of interest. Now, if there is no exchange rate fluctuation at all, we obviously can make a decision that New York is giving us the highest rate of interest. And we have the money also in US dollar. So there's no need for any conversion or anything. Invest in US dollars only. 500,000, invest them in New York and get 8% return per annum, which is equivalent to 2% for 3 months. So let me say, convert it into what is your return quarterly. Here it is 0.75% per quarter. And here it is 1.25% per quarter. It's because we are going to invest only for 3 months. So we will see where the investment is most fruitful. The cost of funds to the bank is 4% per annum. It proposes to invest these funds in London, New York, or Frankfurt and obtain the best yield without any exchange risk to the bank. The following rates of interest are available at the 3 centers for investment of domestic funds for 3 months. Okay, so these are the rates. You may invest in London, New York, or Frankfurt, and the final rate of interest you will get per quarter is this. The bank's London office is there, so maybe you can calculate your final answers in terms of pounds. Okay, so either you calculate in euros or Deutschmark, dollars, or pounds. Where will you like to make the investment? Further information is given. The question is continued here. The market rates in London for US dollar and euro are as follows. London on New York. Spot 1 month, 2 months, 3 months. So we are not interested in 1 month and 2 months because we'll make an investment and we will see how much we get after 3 months. Similarly, London on Frankfurt. This means 1 pound is equivalent to these many dollars. So you can say that the rates quoted are dollar by pound here. And here again they are quoted euro by pound. Okay. So once again, these are not relevant to us. We can ignore. Which center will the investment be made? And what will be the net gain to the nearest pound to the bank on the invested funds? So first tell me, where will you like to make an investment? Let's see. 500,000 USD is what you have in the London. If we are investing in USA itself or London or Frankfurt, Germany. So if you invest in USD 500,000, 2% is what you will get. So 2% will become 10,000. You will have 5,10,000 USD. Convert them into pounds. After 3 months, the rates are, we can see the swap points are increasing. So it is 1.5430 oblique 1.5475. Okay. You need to sell US dollar to convert it into pounds. So you will end up getting 1.5430. Bid would be applicable, but we are given indirect quote. So we need a direct quote. So 1 upon 1.5475. You end up getting 3,29,563.81 pounds. Okay. Look at the question again. London office. So do the calculations in pounds. Surplus funds are lying in USD, 3 months. Proposes to invest in London, New York, or Frankfurt. So because you have USD, if you invest in New York at 2% for 3 months, don't need to convert. 5 lakh would be invested, and when you will invest for 2% at the rate of 2% for 3 months, you will end up getting interest 10,000, and your total USD after 3 months is 5,10,000 USD. When you will convert it into pounds again, you end up getting 3,29,563.81 pounds. Rounded off, 3,29,564 pounds. Okay? You will use the swap rates. This is, you will sell the US dollar and get pounds. So when you are selling, bid rate would be applicable, but these are indirect quotes. So you will have to convert it into direct quote for USD. Let's say we invest in London. So first, the 500,000 pounds will become how many pounds today? $500,000. Today's rates are these. So if you want to sell USD, ask would be applicable, right? Bid would be applicable, selling USD, but 1 upon bid would be ask and 1 upon ask would be bid because we want an indirect quote. So 500,000 divide by 1.5390. You end up getting 3 lakh 24,886 pounds, and they are invested at the rate of 1.25%. So the total pounds you have is 3,28,947 point something, but we'll round off to lower level number. So you end up getting pounds 3,28,947. Here you already converted it into pounds, so you don't need to convert it into pounds towards that. You have got this much amount. So far you can see it's more fruitful to invest in US, but we have one more option, which is Frankfurt. Now you need to convert your dollars to euros. For that you need a rate, euro to dollar is what you need. What you have is dollar to pound and euro to pound. If I inverse this quote, I end up getting pound to dollar. And then when I multiply pound to dollar with euro to pound, this gets cancelled. You are left with euro to dollar. That is what you want. So in the spot market, first I will inverse this and use this directly. So euro to pound becomes bid and ask 1.8260 divided by 1.5390 oblique 1.8290 divided by 1.5350. Okay, I have inversed this, so this ask will be used as bid. the rates that come up are 1.8260 divided by 1.5390. So you end up getting 1.1864 euros per dollar if you sell, and 1.8290, though we don't require that, 1.5350, that is 1.1915. These are the rates we get from cross currency rates. Now convert the dollars to the euros. So you will sell dollar and you will get 1.1864. So 500,000 multiplied by 1.1864, you end up getting 5,93,200 euros invested at 0.75%. So interest on that after having made an investment is interest at the rate of 0.75%. You end up getting 5,97,649 euros. Convert it into pounds again. Euro to pound. We have pound to euro, so we need euro to pound. We'll sell euro and get pounds. Sell euro means bid rate would be applicable. Swap rates are decreasing. So the new forward rate after 3 months for euro to pound is 1.8260 minus 145 or 0.0145 oblique 1.8290 minus 0.0140. So the new rates are 1.8115 oblique 1.8290 minus 0.0140. 1.815. So 1.8115 minus and oblique 1.8150. All right, you need to sell euros. So ask would be applicable. But once again, we are given the inverse code. So 1 upon, you need to sell euros, bid would be applicable. But 1 upon ask would be bid here. So 597 divided by 1.8150. You end up getting 3,29,283 pounds. All right. 0.19 can be ignored. So where do you get the highest pounds? If you invest in US. Is the question clear? Yes, team, is the question clear?
Yes, ma'am.
So you are in London. Ensure that your final answers are in pounds. But what you have is 500,000 USD to invest for 3 months. London, New York, Frankfurt, all the three places, rate of interests are given. So if you invest in US, all you have to do is get 2%. That means it will become. Okay, thank you, Leela. So 500,000 will become 500,000 multiplied by 1.02, $510,000. And after that, you convert it into pounds. So how will you convert it into pounds? Pound by dollar rate. And that too after 3 months. Swap rates are given. 80-85 means 1.5350 plus 1.0080. So 1.5430 and 1.5475. Now which one will be applicable? These rates are not dollar by pound. These are dollar by pound. We want pound by dollar. Or simply saying that if we want to sell dollar, we can say we want to buy pounds. So ask rate, that is 1 upon 1.5475 would be applicable, and you end up getting 3,29,564 pounds approx. If you invest in London, you need to make the conversion today, not later. So 500,000 divided by 1.5390. Invest in UK at 1.25% per quarter interest. You end up getting 328, which is less. So better to invest in US and gain more. Now let's compare with Frankfurt. Direct rates for pound to euro, dollar to euro is not given. So first we need to convert our dollars to euro. For that we need euro to dollar. What we are given is euro to pound and dollar to pound. So if we inverse this one, it will become pound to dollar. So euro to pound multiplied by pound to dollar will give us our required rate of euro to dollar. After having calculated these rates, we need to sell the 500,000. So bid rate is applicable, which makes it, if $1 will give us 1.1864 euros. So 500,000 would give us 593,200 euros. But they'll get an interest of only 0.75%. So after interest, you end up getting 597,649 euros after 3 months. Convert them back using the forward rates for euro to dollar and euro to pound. Euro to pound are given directly. We get forward rates. Swap points are decreasing. So subtract 1.8260 minus 0.0145 and 1.8290 minus 0.0140. So these are your euro to pound. You have euros with you. You want to sell euros, bid would be applicable. But inverse quotes are there. So 1 upon ask. Ask is 1.8150. So 1 divided by 1.8150. You end up getting 3,29,283 pounds. So which one is the least of the best of the three? Highest return, where are you getting? If you are investing in US. Okay. So which center will the investment be made?
I have a question.
Sure.
Yeah, in case of London, we first converted it to pounds, then we added interest. In case of Frankfurt, Germany,
right.
we added interest, then converted.
Yeah, first we had to convert. For investing in Germany, you need euros. So first the dollars are converted into euros to invest in Germany. Then together with interest, whatever the euros you have after 3 months are converted back to pound to be able to make a comparison that where the investment is best. So all the three answers finally are in pounds, right? They are close. They are not very different. But despite that slight difference, USA is giving us the highest returns. Okay. Is it clear? You are in UK, but you are having dollars. So if you are investing in US, you can make a direct investment. Only you will need to convert it into pounds in the end. if you are in UK, you need to convert your dollars into pounds and then just today and simply invest and get it after together with interest. But if you are wanting to invest in Frankfurt, first you need to convert your dollars to euros, invest the euros, get it back together with interest, convert the euros back to pounds. Now you have your final outcome in terms of pounds in all the three investments. So you
But
will choose the
we
one
added the
which gives
interest
you,
first. We added the
yeah,
interest
first
first in
because
Frankfurt.
you are, yeah, because you are investing in that country. So first convert it into that currency where you are investing and add interest simply on that. So in US, you are getting 2% for the 3 months. So simply 500,000 into 1.02. In London, you are getting interest at the rate of 1.25%. But first convert it into pounds and then get the 1.25% interest. In Frankfurt, first convert it into euros. Then the euro interest would be applicable, which is 3% or 0.75% for the quarter. Okay?
Okay, got it.
So once you've made the investment and your final answers in pounds in all the three investments, then a comparison is facilitated and you can see that your highest return is when you're making the investment in New York. Okay? Right?
Yes.
This MCQ we have done. This MCQ we have done. Let's look at this one more new MCQ. Here we talk a little about transaction exposure. So there are certain exposures that you have when you are dealing particularly in foreign currency. There is a transaction exposure. There is a translation exposure. There is an operating exposure. So if you are dealing in US, you have bought a machinery from US, but you're going to make the payment after some time, then definitely you may end up paying more than what you would have ended up paying in the spot. That's a transaction exposure, right? If I buy a machine for $10,000, today's scenario, I might end up paying 8,80,000. But if I have to make the payment after 6 months and that time the exchange rate changes to 90, I will incur a loss. So that's a transaction exposure. If you have subsidiaries in different parts of the countries, you kind of have a balance sheet and an income statement in those countries also in the local currency of that country. But when you prepare a consolidated statement, you translate all those figures into your home currency or the reporting currency. So sometimes you have a translation exposure. All your items of profit and loss are to be taken at average rate. All your items, closing items, which are of near cash equivalent, are to be taken at closing rates. So this creates a translation. You're translating certain financial statements into a different currency, because of which you may stand to gain or lose. That's a translation exposure. Then you are operating in certain countries. That's a operating exposure you have. So here we'll talk about transaction exposure only. So Messrs. Amica Electronics Limited exports air conditioners to Germany. So export is you are in India, let's say. Export is going to Germany. So you are going to get euros inflow receivables. But what are you exporting? Whatever you are exporting by importing the components from Singapore. So from Singapore, you are importing the components. So therefore, you're going to make the payments to them in US dollar, Singapore dollars. How many units you are exporting? 2,400 units. What is the price per unit? 500. So your receivables are sure 2400 into 500 euros. These are in terms of euros. The cost of imported component is $800 per unit. Payables are 2400 into $800. Singapore dollars. You also incur a fixed cost and some variable cost per unit. This is in local currency, Indian, 1000 and 1500. So this is your import cost plus 2500. 1000 plus 1500. Now what you need to do is you need to find out what is your gain or loss today and after 6 months. So if whatever you are exporting, you get the amount today, how much you will get? 2400 into 500 euros. You end up getting 12 lakh euros. And how much is the cost you are incurring? 2400 into 800 Singapore dollars. 19,20,000 Singapore dollars. Plus another 2500 rupee per unit. So how are we going to attempt this question? First, we will look at the current rupee by euro and rupee by Singapore dollar exchange rates. So if you have to pay 19,20,000 Singapore dollars, you need to buy 19,20,000 Singapore dollars, and $1 is available at 27.25. Okay, so 19,20,000 multiplied by 27.25 rupees plus 2500 into 2400. That's your total cost today. What is your inflow? 1 euro will give you 51.50 and 51.55. So 12 lakh euros would be sold and they will give you 51.50 rupees. So your today, if you sell, your revenue is 12 lakh into 51.5. 61 lakh 80, sorry. 6 crore 18 lakhs. Okay. And what will be your outflow? 19,20,000 multiplied by 27.25. Five crores, 52 crores plus 'So your costs together will be 61 crores is the revenue and 58 crores is the cost. So you end up getting somewhere around 34 lakh 80,000. The same calculation when you do after 6 months, there will be some difference. And if that difference is a positive, you stand to gain. If that difference is a negative, you will stand to lose. So next time you will have 12 lakh into 52. So your revenue would be 62,4. Six crore 24 lakhs, and your outflow would be, the Indian rupee outflow will remain same, but Singapore dollar will change. 19 lakh 20,000 multiplied by 27.75. So 53. And this will remain constant. Minus 62.40. So you end up getting a gain of loss of 3,60,000. Right? So we also discussed about transaction exposures, etc. If you have any queries, please ask. That's all for the day today and for foreign exchange exposure. Thank you so much.
Thank you, students. Thank you, madam.
Thank you, sir.
So with this, we have come to the finishing of the topic of foreign exchange exposure and risk management. And this is a chapter number 10. So we can say that almost we have covered the 2/3 of our all the chapters. Okay, and it is one of the very important chapter because it will form the basis of our next chapter, that is international financial management, where the financial management in context of internationalization, that is, we can say in a foreign exchange context, will also be covered. And further, when we talk about this foreign exchange exposure, this is important from examination point of view as well. Of course, we never encourage a student to be a selective study, but of course, it is one of the very important topic. So here in this topic, broadly, we have covered, again, if you have seen, of course, we have covered a part of speculation, some speculation, etc. But our basic purpose of teaching this chapter was to considering the hedging part, how we hedge our foreign exchange, because nowadays our world, we can say world has become a world has become a village, or we can say we now India has become a global, globalization is there, and India is one of very important country in the overall world, where the import and export takes place. Of course, we export services, we import some petrol, because petrol is one of the, crude oil is our one of the very important constituent of our import. So normally it is only the foreign exchange that normally we can say impact the balance sheets and the profit and loss account situation of a big companies. So hedging is one of the very important part, and that's why this topic is not only important from academic point of view, as well as it is important from practical point of view as well. Now, when we say this foreign exchange, there is another part when we say, because when we deal with the bank, there is one topic, execution of the foreign contract. Now, when we talk about this foreign exchange, execution of foreign contract, or the fate of the forward contract, it is one of the, we can say that, because forward contract, of course, we book, but sometimes situation may change. So in that case, what course of action we have to follow, that is also has been covered. That can be an early delivery, okay, or it can be early cancellation, early extension, because on the due date, if generally we takes any situation, there is not an issue. Of course, on due date extension is there, on due date delivery, there is not an issue. on due date extension, on due date cancellation, of course, we have covered. And there is one very important topic, that is cancellation beyond due date. It is one of the very important topic, and normally a student has to take very careful about the same, because here the rate given matters a lot, and which day cancellation is there, which day the customer approach to the bank. These are very important aspects. So with this, student, thank you very much for the patient learning, patient listening, and also making this session interactive by asking the question to the madam. And thank you, madam. We also thank you for the sparing your precious time and alerting the student. So student, we will see you in the next class for the topic of international financial management. Till revise, whatever the queries are there, you can, madam, just share our share your screen. Just write it down, 0120. This is our contact number. 3045 956. And our email ID is sfm-final @ICAI.in. Okay, student. Thank you very much, and thank you, madam. Have a nice day.
Thank you, sir.
Thank you.
Thank you.
Thank you very much.
Thank you. Thank you.
Thank you.
Thank you. Thank you. Welcome.
Thank you.
Thank you, sir.